Hey everybody, Preston Bryn here with our weekly roundup for the trading week ending in November 6, 2015. Welcome to our Trader User Group free overview for the week. What I've got on the screen here is the E-mini S&P 500 futures. Now I've got a weekly chart on here. I wanted to just step back for a second. We've kind of come a long way over the past since the end of August into October and now the first week in November. You can see here, I've got this line here will divide 2015 and 2014, okay? And for most of 2015, we kind of stayed sandwiched in a couple of different zones. And you can see this zone right here. And we've had two major support zones, I guess, if you will. This is number one, and this is number two for 2015. And we elevated ourselves up from this first zone or this first box right here, right? Which is what we went into at the end of 2014. And then we kind of stayed here for almost the entire year, or at least leading up to that big first move, August 22nd, 23rd, 24th time frame, okay? And then we took the big dive. So looking at this weekly chart, you can see back here when we had our last greater than 10% pullback, you can see here it was around a little bit over 10%, about 204 points on the E-mini S&P 500 futures, you can see. And on this move here coming into August, it was a little bit more severe, about a little bit over 14% that we had this pullback. And then we came down here to 1831. And then we had a little bit of a retest right in this area here. Now it doesn't show it on the weekly, but these are closing areas right here. So the intraday close was right here. This little extension right there happened on a Monday morning. They're calling it the second Black Monday, where it kind of a flash crash, I guess, where we just went way down, stopped a lot of people out, closed a lot of people out of their equity positions. Or people panicked, and then boom, it came right back up into this area here. Okay, so this double bottom on a short-term chart gave us some bullish divergence, and then we all I was guiding our members to go long at this area right here, and we've had a nice run. And then there was another stop-off point right in this area right here. You can see the little zone right there that we finally cleared. And then we've had this second race up here. So what do we need to pay attention to? This long transition right here. We were watching this coming. We were watching the train coming down the track, and we knew that the train was eventually going to run off the rails. We did not know the extent of the damage, but we knew it was coming through some of the breadth indicators I was working with our members on. And I was showing you guys in some of these updates where a smaller and smaller percentage of S&P 500 stocks maintain their 50 moving average, their 50 exponential moving average. Same thing with the Nasdaq 100 futures, or smaller and smaller percentage were maintaining above the 50 EMA. And then finally they had to give it up, and then they did it in just a 2-week period. We fell a little over 14%, and in that 1-day period, or that there was a 3-day period where we had the largest pop in volatility in the history of the markets. Now volatility did go higher back in 2008, 2009. But on a relative basis, on a 3-day period, this was the biggest pop we've seen, and it flushed a lot of people. But now looking at it, where do we go from here? Well, on this weekly chart, you can see we're now right back almost in center line of where we stayed almost for the entire year 2015, right there. We're right back in the center line right here. And now we've got a couple of people that are guiding the markets, or a couple of things guiding the markets. The first thing is the FOMC and the Federal Reserve in the US. They've got a big question mark that's coming up here right around this time frame on the chart. It's do they or don't they raise the interest rates. Now, going into this Friday's employment number, I was telling our members, don't watch what the number is. I don't care if it comes in at 4.5% or 5.5%. I had told our members to expect a number around 5%. That's what the analysts were expecting. And remember, the last unemployment number came in at 5.1. So I said that we're probably going to beat that number by 0.1% or 10 basis points. But I said, I don't know how price is going to react. If we still continue with the good news is bad news or the bad news is good news theme, then we're going to get a reaction opposite of what would intuitively make sense, right? I mean, generally a good economic number, the general equity markets indexes run up, and a bad government economic number, especially unemployment or GDP number, the markets run down. Well, in this case, the markets initially sold off in the equities. So we're kind of still in that environment where good news is bad news. Meaning good news with a strong employment number forces the Fed's hands, or at least raises the probability that they may do a interest rate hike on December the 16th, which is when they meet again before we go into 2016. And Yellen and came out and said last week that it's still on the table very much for an interest rate hike. Now, she's kind of between a rock and a hard place. And, you know, you can guess one way or the other. You can pick a side. We don't try and pick a side. We're following the price action. And even I would submit that if you knew what she was going to do, you still may get it wrong as far as the price action. For example, if she raises the rates by 25 basis points, longer term, I think that'll be, longer term being 90 to 120 days, I think that'll be a net positive for the markets. Short term, meaning less than 5 trading days, I think that'll be the markets will sell off a little bit. And then I think buyers will step in at that point. That is just what I have been seeing right now with the way price action has been reacting to government numbers. So what's the Fed's going to do? I don't know. It was a 35, the futures market was pricing in a Fed's fund interest rate increase of 35%, meaning there's a 35% chance they'll come in and raise the rates in December. Now that this very strong number hit the wires on the employment situation, it increases those odds over 50%, probably around 60%. And you can find a number of people that profess to be great economists and others that say she's now got to raise rates, and you see a few others say no, she's still going to hold off. Guys, don't get caught in that game. It will drive you crazy. This Fed, this group of 9 voting Fed governors, has a communication strategy, as I told our members, pretty much like Lucy and Charlie Brown. There's a big movie out this weekend on Charlie Brown, the cartoon, and every time it reminds me of when Lucy would hold the football and say, come on, Charlie Brown, kick it, and Charlie Brown would go to kick it, and then you all know the result. Lucy would move the football away, Charlie Brown would swing at it, miss, and fall and land on his backside and butt. Well, that's kind of what the Fed communication policy is here in the United States. We're going to raise the rates. We see that there's nothing standing in our way, and then every time they have a meeting, they punt until the next meeting. They pull the football away again. There's so many times they can do that before they screw up their believability in the financial markets. My personal opinion is I think they should raise the rates 25 basis points, get it out of the way, have Yellen step up the podium, and if you can stay awake while she's telling what she's telling, because I can't understand a word that woman says. She needs to speak just plain English and just says it the way it is. We've raised the rates, but we don't see another rate hike for at least another 3 to 6 months. We're going to have a very low trajectory, a very low and long liftoff. We got a long runway ahead that'll soothe the markets, and we'll see probably a little bit of a sell-off, and then it'll be a good opportunity, a good buy-in opportunity. Okay. Now, what I would like to see happen and what really happens are two different things. So again, I come back to what's going to happen right here. Well, we follow the price action, and what the price action is saying now is we're probably going to be stuck in this range. We may poke our heads above the 2134, which is the all-time high for the E-mini S&P 500 futures, which we stayed inside this box here. But I don't see a lot here pushing us much higher. If we look at the earnings, we're about 80% of the companies are through with earnings now. And including energy, earnings are the revenue growth is a net negative. We've not done very well. Since 2009, we haven't had as good of a revenue growth. So there is none. Now, if you take energy out of the equation, we've had about almost an 8% increase in earnings. And so the big question is, energy is a big factor in the market, which is why we've been playing energy and having a good fun time this year in 2015 with the energy market, primarily in oil futures and now lately in gasoline futures. But looking at this chart, I've also, and let me just clear this screen up a little bit for you. So let me just get this off. I've run a couple of Fibonacci's on here. The first from the high of 2134 down to 1831, which was the low here. And I think the low has been made near term, at least through most of 2016. And I've also run a Fibonacci extension off the top. You can see this represents about, it says 304 points. It's really, if you do the math, it's really 302 points, 302.23 points from the high here down to this 1831 area down here. Okay, so that's kind of the distance that we've traversed the entire year. And by the way, we did not take out the October low. That was our line in the sand for us. As we were coming down here, we didn't take it out. We had that double bottom right there, and then we just got up, and I was getting long right in that area right there. And then I said if we took out this resistance point right there, we would filter on up through, which is what we've done right now. So now the question is, what have we got? We've got a near-term support here around the 2062 area. Okay, this is a short-term Fibonacci. This area here, you can barely see it, 1789 is the number. That is a long-term fib level. It's not an official fib level. I use 236 all the time. It is a very good number to use when you've got a strong bull market. Markets tend to pull back like this to that point. We almost got there when we came down to 1831. So 1789, 1790 area, I think that's going to hold through next year as far as I can see right now. But looking forward, you can see I've got a near-term support right here of 2062. So that's going to be my S1 going into next week, our first level of support. And if I were to extend this across, you can see that it's tended going all the way back to the summer, April, kind of been our hold point right here, right? It's been a little bit of a support point for most of through April of this year. So that's why I'm selecting that area, give or take plus or minus 3 or 4 points. 2062 seems to be a very good number. If we take out 2134, and I don't think we will before the Feds come out on December 16th, but we could. Remember, volume is low in this move going up. A lot of this move is short covering. We're doing a lot of buy stops on the short covering and clearing out all the shorts. Now we're looking for new longs to come in and take us above 2134. I haven't seen a lot of reason for that. And if the Feds raise their rates, it's going to put weakness in the market. Like I said, on December 16th, could sell off a little bit before we kind of move back higher again. We are coming into the silly season for the year, October, November, December. In the month of October, we had about an 8.8% move up in the S&P 500 futures. And now you've got November and you've got December right here. So looking in total, October, November, and December, on average, going back about 20 years, we average about a 4.3% rise. When in looking back in history, when we have a strong October, then the November-December up move is only about 1% on average. So if we look at that and apply that to these numbers here, that puts us somewhere up in this area right here, tops, right? And I've got an extension here, if you can barely see, at 2205. So let's call it 2200, roughly to the upside. So net, looking as we go through the end of the year, what I'm seeing price action showing me is an upside of about 2200, okay? And then a downside coming back down to around this area right here, which was this level of support, and I'll put it as a zone, which is really what it should be, right in that area there. And that gives us, call it right around 2000, okay? So I'm looking right now at an upside from current prices of about 2200 minus the 2093. So that gives us about 107 points upside from the 2093, and that gives us a pretty good strong move up. I don't think we're going to get there. I believe that the downside is a greater risk than the upside. Okay, and I think if we do grind up in this area here, we're going to be held up in this point right here. And if the Feds raise their rates, it's going to put some downward pressure on the markets. But I'm going to use any downward pressure, especially down around to the 2000 area, maybe a little bit lower, 1982, to pick up more longs. That's the way I'm going to look at this. Okay, so now, the other thing that I'm going to do on the chart here, let me just get rid of this. I'm going to clear this up, and I'm going to put some other indicators on the chart here. So just to show you guys, and by the way, when I step back out in time, it's on a weekly chart, so just keep that in mind. And we move it out, you're going to see here, right in this area here. This area here was the 2007 peak, which is right around the 38th percentile fib node, which is a natural fib node, right? And this is from the pivot low of March, right around March 9th of 2009, all the way up to the pivot highs of 2134. You can see these areas right here. So to me, I do believe this is a higher probability going into 2016. As we finish 2015, no, I do not. You can see that area right there, give or take these really fast one day spikes down like that. This is going to be probably a pretty good little hold area here, right? Which is around that 1890 area. So I think eventually, sometime in 2016, we're probably going to scare the children and come back down into that area again. But near term, going out for the next couple of 6 to 8 weeks before the end of the year, you can see that really robust move up. I can see a little bit of weakness, and then finishing, if we break 2134, it won't be by much. Okay, so that's kind of what I'm seeing here. Now, if I take it down to a 2-hour chart, which is what we use for the next week, where do we go for the next week? Because a 2-hour chart is a really good system to use to be able to track, short-term movement here. And then I'm going to put my other indicators on the chart here. Now it gets very busy, but let me just widen it out, because you're probably like flipping out now with all these lines. They all mean something. They all have key support and resistance points to it. You can see this blue line right here represents the opening price of the S&P 500 for the year, 2055. Okay, so that is a hard and fast number. You can see back over in this area here, we stayed there for about a week on this 2-hour chart. We kept testing it, retesting it, and this is what I call a headline number. If the markets move below 2055, then the rat brain business journal, the National Enquirer, comes out and says markets back in the red. all the papers pick up markets are in the red for the year, markets are in the green for the year. And that's when the rat brain trader notices. Okay, for you guys, you and me, we don't see that. We're following the price action. The other thing that I wanted to show you on this near-term chart, and I got a lot of drawings on here, so I'll try and make it simple for you. You can see here I've got this upsloping channel right here. It's a channel that we've been in. So we have been in for quite some time now, going back to about the third week in October with this big move. We've been making higher highs like that up the channel, higher lows up the channel, right? Like that. We stepped outside the channel right here. We had a little bit of a scare. And the markets quickly reversed within the day to day and a half. So, and we've been using this to pick off long entry points. Why? Because we are in an up mode on a daily chart. So we swing down to the 2-hour chart looking for buy points. And we get these buy points at the bottom of the channel, expecting the market to move back up. Now you can see there is a resistance zone here, which is where it stopped us out last time. I'm expecting a little bit of chop, but possibly back up to this resistance zone, and then we've got a moment of truth. This is our R1, okay, for the week, roughly up to 2110, okay, and that is kind of the R1 zone. It's actually a zone. Now the price right now closed at 2093, so that's about 17 points north. We can hit it very quick, and we'll be in this resistance zone right here. If we break it, we're going to come up to the next resistance zone up here. That is around 2120. Okay, remember 2134 is our all-time high, so it's just above this resistance zone right here. The other thing that so we've been in this buy the dip rally all of the month of October. There was an entry point here, an entry point here, an entry point here. So we've had, for folks that were sleeping at the wheel, we've had 3 opportunities, 1, 2, 3 opportunities to come in and jump on these longs. Most rat brain traders jump in long and they try and chase it up here. It comes back to the bottom of the channel, they get out, and then it goes back up again. And then they tell their friends, just do the opposite of what I do and you'll be good. Well, no, you dumb shit. You don't do that. You buy at the bottom of the channel. You need to know when we're a buy on the dip mode or a sell the rally mode. Right now, we're a buy on the dip mode. Okay, now that may shift. I'll tell our members when it does, but that is kind of where we're sitting right now. Now, getting to the daily chart, I will show you a couple of other things. Now, it's a busy chart, but I wanted to show you a couple of key things that are looking like they're going to happen again. That'll put more wind in the sails of bulls. You can see right here on a daily chart, we had the 50, which is the red line, crossing the yellow line, which is the 200 EMA. That is a death cross. I have always told our members, when you see that, pick up some longs or sell puts, because almost inevitably, more than 65% of the time, you're going to get a bounce back up towards the cross. And that's kind of what we had in this area right here, because we were way down here and then we just kind of moved back up like that to the cross. And the reason why is because you've got a lag in the 200 and the 50. By time it's hit here, you're already oversold. All right. Now we had this bullish divergence here in the price action, and that bullish divergence where we really got long and we got more aggressive, I guess you could say, in our longs was down in this area right here. You can see right here that even though intraday we came down here to that 1831, you can see where we closed right there. Okay, so those were closing prices. So I call that a double bottom, right? Discounting that, you know, early morning move down and then back up again. It gave us that bullish divergence. When we got the signal, boom, away we went to the races. This was our first hurdle right here, as I showed you, and I got it marked on the screen. I said if we take that out, we're gonna really get into more longs, and then you can see that dip down like that. That was a buy entry right there on the 2-hour chart. You can see another dip down, a buy entry, a dip down, a buy entry. So there was a number of opportunities for our members to get long. If you're having trouble with this, or you don't quite understand it, I would highly recommend you come over and join our group, because I spend time going through helping you time your entries and exits, and are we in a buy on the rally or sell on the dip kind of mode, okay? So this is the E-mini S&P 500 futures. Now, one of the things I like to do when the markets are moving up or down, we look at the lead dog and we look at the dog that's kind of bringing up the end of the pack. Well, the lead dog in this case was Nasdaq. And if we look at the lead dog, look at the lead dog. It made new all-time high, well, not all-time highs, close, but discounting the dot-com bubble. But if you look at it right here for 2015, 47.29.75. So we actually blew out our previous high over here by just a little bit, right? We made highs here. We have no bearish divergence in this. So any pullback in Nasdaq, again, like the E-minis, this would be a S1 zone right here. You can see it very clearly around 45.50, right? So that would be a support point right there. That we can see some softness here in this action. Wouldn't surprise me to see the S&P come back here, or the E-minis. Now, we got a very brief 50 below the 200, but then it went right back up again about 2 weeks later. There is a cross right there. Now, what do I tell our members when you get a cross? Sell puts or go long, and right down in that area there, what did it do? It went right back up to the cross. So the odds are more than 60% that when you do have a cross, it's going to move back up. Now, what you don't know, because we're into the resistance here, was it going to fall back down again and find support here, or go back up? Well, we did have a brief move up, a test, and then boom, away we went. When we broke that channel there, or that downsloping line, that was a signal that we were a buy on the dip rally, buy on a dip on any rally. So that's what we've done. So now this is where we're sitting right here. And like the E-minis, December 16th is going to be a key date. Now the markets are starting to price in an interest rate rise. So if the Feds actually raise the rates, it'll surprise some, because they're still, it's not 100% factored in, but they're starting to build that price in now, which is why the day chart of the E-minis, if I come back to the day chart, and let's just put it on a 5-minute chart here to really kind of take a hard look at that. And if we come on a 5-minute chart here like this, so this is the day, and you can see here at 8:30 in the morning here, let's get everything off the screen so you guys can see it a little bit clearer. You can see here at 8:30 in the morning, this bar right here, 5-minute bar, you can see the move up and the move down, and we just kind of all over the place. It came down and tested, it moved back up, it made a new low down here like that. So we were making lower highs, and then that low held, as it turned out, and it held several times, right? It held right in this area here. So we were testing it, and then on this one right here, we were getting this bullish divergence, right? We were getting the bullish divergence, and then we just kind of moved back up. We took out these key pivot highs. We took that one out. Then on this one here, we took that one out. We started to make higher lows like that, and then by the close of the day, we were right back, right at where we started before the announcement. We pulled back a little bit into the announcement, and we ended up almost flat for the day. All of this, guys, was a lot of noise. It was people jockeying for position. It was people recalibrating their portfolios. There were a lot of sells out there. There were buys on different sectors. There was a lot of jockeying around. But at the end of the day, you know, the markets ended back up again. Volatility was down, and that's kind of where we are. We're going to have this kind of jockeying, only more extreme, on December 16th, okay? But the good news is we did finish right in this area here. I do believe if they raise the rates 25 basis points, I will be a buyer on dips. At least that's where I'm sitting right now. Now, speaking of news, I'm going to leave it on the 5-minute chart. Let's look at bonds. For those following me in bonds, we had a great trade on Friday. Right in this area here, bond futures. You could have done it on TLT. I posted out in our chat room. You can see this very tight range overnight, um, and then leading up to the announcement, and then bam, away we go. And it was just, we found that little bit of a bottom there, and we just barely got up off the floor here, but we're basically on the floor. I did an at the money straddle in bond futures, okay? And it turned out to be a very nice trade. Made some good money on it with this straddle because it really moved. Now, volatility was a little bit higher in the bond market, obviously, so you're going to pay a little bit more. So I needed a move greater than at least one handle. And I knew that if we got a surprise, I was expecting 5% on the employment number, but I said, I believe one way or the other, we're going to get a move greater than one handle. That's one full point in the bond futures, which is $1,000 per contract. As it turned out, bonds finished down one full handle plus 24 ticks. It was down at one point over 2.04, two handles and 4 ticks, right? So, but I think there's going to be more downward pressure on bonds. So bonds did exactly what we would expect. Okay, I mean, generally with a potential rise in interest rates, you're going to see bonds sell off. And if we come back to the daily chart and we look at bonds, you're going to see that big down move here. Now, we've got this hard test here. If this breaks, I'm short bonds right now in the bond futures market in options. But if we take that line out right there, I'm going to add to my shorts because now it's going to take us down to about 147 roughly and some change. I think bond market's got to digest this, so we're probably going to float around here a little bit. We took out the 50 EMA, we took out the 200 EMA. The 200 EMA is sitting at 153.08. Okay, in the bond market. So I believe we could probably come up and test that area. It would be very logical for me to see it test it, but I think there's going to be a tremendous amount of downward pressure on the bond market. So any rally here, I'm going to be selling the rally. Equities, I'm buy the dip. Bonds, I'm sell the rally. Of course, you can take TLT if you can't trade bond futures, trade that to the downside. You can take TBT and trade that to the upside. Or you could trade ZB, which is the bond futures, trade that to the downside. Or you can trade ZB options, right, which is the options on the futures market, and you can trade that with a whole plethora of options on that, ratio diagonals, ratio spreads, bear put spreads. There are a whole number of things you could do here. So right now, the big move's been made. And I'm going to let this thing settle in. If we break 151.28, we're off to the races again. I'll add to my position, and then we'll see where we go. So the bonds did according to plan. The other thing that moved according to plan was in the currency market. Most of you guys know I was short the euro. And you can see what the euro did here. It just fell. It took out a key point here, as you can see, the 108.21. You can see right here, it held us up. We took it out right here. I think we're going to come down to this 104 area. Folks, it's going to be choppy down here. Anytime you get these big, fast moves down, any counter trend move, you're going to have a lot of shorts jumping into the euro market right now. It's not a gee whiz Einstein trade. Everybody wants to go short the euro. So what happens when everybody goes short the euro? There are a lot of buy stops, which means any counter trend rally is vicious and aggressive because all those buy stops are activated. Are activated by it moves up with all the buy stops. So, but then once that's done, there's no more longs to come in there, and then it goes back down again. So these sweet spots here are great sell in any rally kind of environment. So that's where we are with the euro. And then by the contra of that, we look at the dollar index. We'll look at the dollar index. As I said, it would move up and take out this shaded area on any potential interest rate hike. That's what it's done. We're now going to move up to the 100 area. We're at 99.26 on the dollar index futures, and I see us moving up here and taking that out and coming up to 102. So being long the dollar, short the euro is a trade to me that makes a lot of sense. Okay, so that is a trade that I like to see. We were in the Australian dollar. Remember, a stronger US dollar means a weaker Australian dollar, probably a weaker Canadian dollar as well. You can see these currencies coming back down and testing this area again. But once it gets down here, I'm going to watch this. There's going to be some great trades coming up in 2016 in the currency market and in the energy market. If we look at the energy market with oil, um, it's starting to, we had a pretty good little pullback here like this, but I do believe that energies are going to move back up again in December, January timeframe, so our members are going to be onto that. Same thing with gasoline futures. You can see gas down here is probably underperformed more so than oil. So in December, January, February timeframe, I think we're going to see a push up in gasoline futures. XLE, which is the oil energy industry sector, has been bullish. We've been playing that with one of our favorite trades there. So our members, we've been doing good there as well. So these are just some of the many trades that we've got running. We've got others that are looking pretty good as well. If you're not a member of our group, I highly encourage you to come on in and check us out. I've got an offer attached to this that is I think a very good offer. Anyway, go on and check it out. If not, then just enjoy our free weekly updates. Have a great weekend, everybody, and I will see you guys next week. Members, I'll see you tomorrow night in our weekly market watch for the upcoming week. Ciao, everyone.